I want to start this lesson off a bit differently than I normally would. Right now I'm logged into my personal Facebook account, and here's a screenshot of a conversation that I had with a friend of mine prior to the market opening. And here in the Pacific, the market opens at 6:30 a.m. And as you can see, RWLK was the stock that I had picked for the day. And after looking at a few stocks in the pre-market, I had a moment similar to the one the guy in the very first Harry Potter movie had. I'm not sure if you guys remember, where after selecting a bunch of wands for Harry to try, he finally says, I wonder. Then it happened to be that wand. And in this case, RWLK was the one where I went, I wonder. Now, of course, out of the thousands of stocks that are being traded on the exchange, I was able to narrow it down to this one in particular. Of course, developing that skill takes time, and hopefully with the knowledge that I'm showing through these weekly lessons, you guys will hopefully be able to do the same one day. Now, what brought my attention to RWLK was the recent substantial drop in the stock price over the past couple days. And personally, I like to picture these price actions as an elastic band being stretched and released. So the stretch here was the decline in the stock price, and the release, of course, was the spike on back up. And of course, there had to be a catalyst for making this spike occur, and that was due to the press release that happened today. And it says that the U.S. Veterans Affairs Department expands its access to rewalk exoskeletons. Now, I do, however, apologize to my StockTwits followers for not adding RWLK to my watch list. But I am glad that for those of you who did manage to go through my watch list, let's see here, let's quickly check, and you'll be able to see that the ticker XERS was there, which closed up about 9% today. I'm not sure what's not shown. So if we take a look at the graph, yeah, there's XERS, and it ran up 9%. I'm looking for a possible continuation on this play for Monday. So let's begin the lesson now, and today we'll be covering indicators. I've decided to split this lesson into two parts, so that the first part will cover the simple moving average and the exponential moving averages, while the second covers a few other indicators that I use. So if we Google indicator, we get the definition here that a thing, especially a trend or fact that indicates the state or level of something. Or the second definition, a device providing specific information on the state or condition of something in particular. And as you probably might have guessed, I've highlighted here providing specific information. That's the definition that I'm looking for when I think of indicator. So an indicator provides specific information. Knowing that, we'll go ahead and look at our analogy for indicators. Here, I have a chemical indicator, and it's called phenolphthalein. For those of you who don't know phenolphthalein, it's used to tell whether or not a solution is going to be acidic or basic. So if this was all a clear solution that we're looking at, if we add phenolphthalein to it, and if it turns pink, that means it's a basic solution. So an indicator provides us with information. And that analogy can also be used to help us understand technical indicators. So these are the different indicators that are out there. So one of them could be the phenolphthalein, but it's not. It'll probably have a different term to it. And it will help us understand whether or not the price action is going to be bearish or bullish, or is it going to go up, or is it trending down. Now the moving averages here, there are two types: the simple moving average, or the SMA, and the exponential moving average. The simple moving average is all the price is given equal weight across the measured period, whereas the exponential moving average price, the recent price is given more weight. And so keep in mind which of the two you will most likely be using, and of course you will use both, but in terms of if you're a day trader, a swing trader, or a long-term investor, in other words a position trader, then which one will you give prevalence to? So here are the commonly used periods for the simple moving average, which is the 50-day, the 100-day, or the 200-day moving averages. And if we take a look at the EMA, the commonly used periods for the exponential moving average are 4, 8, and 13. And of course, the ones that I've highlighted in red are ones that I know for a fact are extremely important, but the others I'm not too sure. Some choose to use it, others not so much. And the EMA 13 here, some also argue that it could be 12, but I mean, really, there's not that great of a difference between the 12 and 13 EMA. So how do I apply this knowledge? Well, when the price crosses above the moving averages, it's usually a potential bullish signal, and when the price crosses below the moving averages, it's usually a bearish signal. So if we go ahead and take a look at a graph here on stockcharts.com, we can see that a great example here, when the price falls below the 50-day moving average, the bearish trend continues. And here, the 200-day moving average acts as support where it bounces off. And then now, the 50-day moving average is acting as resistance. And once it does try to break past here, as you can see, the disclaimer that I did put here, note that these are potential bull and bear signals, and that these aren't really an error-free signal. And we can see here that it does cross over, but it quickly fails and continues its descend on down. And I guess there must have been support here. It bounces up and gets rejected again, and rejected again. But here it looks like it's consolidating, and then here it pops on up, crosses above both indicators, indicating a bullish trend, goes up to from 16 from 11 roughly, bounces back, and now turns the 200-day moving average into support, and it again bounces on up for a plus 12% today. In summary of this lesson, ask yourself the following questions. Which moving average and what periods should I focus on if I'm a day trader, swing trader, or position trader? Why should I use the commonly used periods in the market and not necessarily use unique periods for the moving averages? In other words, why should you stick with using the SMA 50 or the SMA 200 instead of coming up with something random like the SMA 235 or the SMA 2? And ask yourself, does a potential signal mean it's an absolute signal? And I think we found the answer to that in our example. So thank you for watching, and of course feel free to like and subscribe, and as always leave any comments or questions down below and I'll get back to them as soon as I can.